European transformation, also a professor here of finance at Frankfurt School. So a little bit of housekeeping stuff. So first of all, we're going to record the session. And after the webinar in a couple of days, you can see the video which is going to be uploaded on YouTube. And we're going to share also the slides on our website. So after the webinar, you're going to receive an email with all the relevant information and also the links. So why are we doing this? Just briefly, I think last month we started this webinar series, and we're going to continue going forward on a monthly basis, also in next year. And the key idea was to kind of open sort of the black box of AI, because we have realized both not only on the practical or practitioner side, but also on the academic side, that's a lot of question as to how these AI models actually work. And so we thought it's actually a good idea to introduce this webinar that focuses on this AI application and also how it's actually used in practice. And this is why we decided on this more, I think, unique approach to have two people as speakers, both one from the academic side and also one from the practical side. The webinar is supposed to be highly interactive, so you can also get involved in two ways. On the one hand, we have a chat function, and the chat function is purely for like technical support if something's not working. If you want to introduce interesting questions and comments for our speakers, you can do this via the Q&A function, which we're monitoring constantly. There you can also upvote and downvote questions that you might be more or less interested in. And then we can bring this into the broader discussion after the introductory remarks of both Bryan and Max. So let me briefly introduce our key speakers of today. So we have Bryan Kelly. Bryan is the Frederick Frank and Mary Tanner Professor of Finance at the Yale School of Management and also the head of machine learning at AQR. He's an outstanding academic. His fields are asset pricing, machine learning. He's currently the editor of the Journal of Financial Econometrics and has been co-editor of the most prestigious journals that we have in our finance profession. Before joining Yale, he was a tenured professor at Chicago Booth School of Business. He earned his bachelor's in Chicago, his master's degree at the University of California in San Diego, and then the PhD at NYU, where I met Bryan, and we've basically known each other now for the last 15 years or so. From the practitioner side, we are very happy to introduce and to have here Maximilian Stroh, who is the head of research at Quoniam Asset Management here in Frankfurt, and who's using economics and natural language processing methods to develop the methodologies and risk models at Quoniam. Before he joined Quoniam, he has worked at Invesco, where he also applied machine learning in the context of different investment strategy, and worked also at Metzler Asset Management in the fixed income area. Max also holds a PhD in mathematics from Goethe University and also a CFA. So thank you very much, Bryan and Max. We're both very happy to have you here. And before we actually move into the webinar itself, what we'd like to do, we would like to have your ideas or your expectation, what you think the webinar is about, and specifically with regard to the topic, sort of the virtue of complexity in asset pricing. So what we did, we set up two polls, which we're going to start now. We have like 1 minute or so for each, in which you can choose between different questions, what you would expect. And let me start with the first one, which is, do you believe that asset pricing models with many factors, as suggested by AI-based approaches, provide better real-world predictions than traditional models with fewer factors? So I give you a few seconds to provide your thoughts on this. Few more seconds. Going to close the first one, and let me open the second one, which is, what do you think is the key limitation of traditional factor models like the arbitrage pricing theory? So what we're going to do after we close the poll in a few seconds, we're going to start and give the speakers first some time in order to provide their the presentations and thought on this. And afterwards, we're going to enter in a little bit more broader discussion based on also what you guys provide as question into the chat room. All right, so I'm going to close the poll now. And now I'm actually going to shut up and give the floor to Bryan. Thank you so much, Bryan, that you're here, and look forward to your presentations.
Slides look okay.
Perfect.
Great. Thanks to the organizers for inviting us. It's great to see you. So this is joint work with Semyon Malamud, who is a frequent co-author of mine on financial machine learning topics, a student of mine at Yale, Barry Ke, and a former student of ours now at University of Melbourne, Antoine Diedesheim. So the title of this paper has changed relative to the title for the seminar series. We're calling it APT or AIPT, as in artificial intelligence pricing theory, the surprising dominance of large factor models. I want to jump right in and get started with thinking about the foundations for this research project, and actually this much broader research agenda that I've been focusing on. So I think a good place to start to think about complexity, which is one way of describing models with very large number of parameters relative to the number of data points that you have to look at, is to sort of ground this topic in traditional statistics and econometrics. All right, so I was trained in a lot of my PhD work as a time series econometrician, and this is a kind of a foundational textbook by a very famous statistician named George Box. And the first chapter of this textbook is called something like Building Effective Models or something like this, but it's a list of 4 rules, and rule number 1 in chapter number 1 of this textbook is the following. It is important in practice that we employ the smallest possible number of parameters when building our models. All right. The reason why I want to start there is because this is where the vast majority of us were trained, right? And this is going to be a bias that influences the way we think about doing modeling in economics very broadly. All right. Now, this seems like a sensible principle, especially when you're trained on it for years and years. But of course, it clashes with what we know about modern machine learning. But you don't have to look very far in the real world to see very well-functioning models that have absolutely exorbitant parameterization. So things like GPT, its current incarnation uses something like 1 trillion plus parameters. The work that I do on financial machine learning, doing things like building neural networks for return prediction, they're puny by comparison to GPT, but they're massive from the perspective of traditional finance models. Right? So if you're kind of trained by the Box and Jenkins way of viewing the world, right? The traditional econometrics way of viewing the world, this looks absolutely insane, right? These models are using way too many parameters. They must badly overfit the data, and they must therefore do horribly out of sample. Right? But we've lived through this now. We have the benefit of seeing history play out, and we know that this is totally wrong. These massive models perform extraordinarily well. Right? The very fact that you can have a conversation with a chatbot and have it feel like you're talking to another human is just a vindication of the fact that you can build forecasting models for language, for example, that are extraordinarily accurate at describing the way humans behave. And they do this because they have so many parameters. And this is not sort of a narrow phenomenon. There's a great paper by Misha Belkin in the ML literature that kind of shows, as you look across models in the ML space, it's very generally the case that for whatever application you're looking at, the bigger models tend to deliver better out-of-sample performance, right? So I think that viewing this research agenda from the perspective of the principle of parsimony is a great way to start, because we can understand how much is being controverted with this modern machine learning way of thinking about things. All right, so of course, this is a finance seminar, and I do my research in finance. And the key point that I want to make here is that this sort of overturning of the principle of parsimony, the benefits of using very highly parameterized, complex models happening in finance too, right? So the finance literature and its use of machine learning methods has been advancing rapidly, right? The past 4 years, 5 years have seen enormous growth in the deployment of AI methods, ML methods for finance. And one thing that we've shown is that these models do well out of sample. The empirical gains when you bring these models out of sample, despite their heavy parameterization, are non-trivial. They're large, they're impactful, they really change the way we think about building good models in finance. But despite this evidence, right, there's a lot of skepticism about the place for machine learning in finance research, right? And I think the skepticism comes from two places. So one place that it comes from, and I sort of think of this as the healthy skepticism, is that, you know, finance people have to admit that historically we've had a little bit of a tendency to data mine the few data sets that we have to look at and build models that might not perform sort of as well in a true out-of-sample environment as we were finding when we sort of started to explore the data over and over again in an in-sample environment, right? So that's sort of the insidious perspective on data mining. That is a healthy skepticism. We should be skeptical of building models that just fit the training data and don't work well out of sample, right? But of course, modern machine learning focuses first and foremost on out-of-sample performance, and that's going to be the focus of all of the modern financial machine learning literature. Now, the second origin of this skepticism for financial machine learning is actually the quote from the previous slide. It's a bias. It's an inductive bias, if you will. It's a bias that comes from the fact that we were trained with a particular cultural perspective on how to approach problems, right? So it's almost a cultural phenomenon. And that skepticism, I think, is unhealthy. And I think it's a skepticism that we need to unlearn and be open-minded to the idea of machine learning for applications like finance. So very much when I think about the virtue of complexity, the virtue of using extremely large models, right? It's about doing research to build the case for doing financial machine learning. So I alluded to the research agenda. This has been the bulk of my research for the past 3 or 4 years, and will continue to be the area that I'm focusing on for the next few years. So one paper that sort of started it all is this paper in Journal of Finance, Virtue of Complexity and Return Prediction, where we introduced a lot of the ideas that we'll be talking about today in a very simple environment. In a problem where you're doing pure time series forecasting for a single asset, like the market, right? And what we show here is a theoretical property of highly complex models, of large models. And the property is sort of fascinating and counterintuitive. It's that as you build bigger and bigger models, and when I say bigger, I mean, think about holding the information inputs to your model fixed but using those information inputs in much more flexible, much more highly parameterized ways. As you increase the flexibility of models by adding more and more parameters, models generally do better out of sample. So you can define do better in a lot of different ways. You can look at it from a statistical perspective. Do I forecast better? You can look at it from a finance perspective. Do I trade better, right? Can I build more productive trading strategies? And the point of this project is that no matter how you look at it, bigger models with more parameters holding all else equal tend to do better out of sample, right? It's a counterintuitive result. And for those of you that haven't been exposed to this idea of the virtue of complexity before, it also has a manifestation in the machine learning literature under a couple different names, things like benign overfit, things like double descent. I encourage you to take a look at this paper. We put a lot of effort into trying to frame the discussion and draw out the intuition for how this strange counterintuitive benefit of big models actually happens. And it's a very generic phenomenon. You'll see this in a lot of places. So what we're going to do in this paper is we're going to take this theory further, all right? So we're going to move from a simple single asset environment to the more standard environment for empirical asset pricing, which is the cross-section of assets, right? So really what I'm thinking about now is what is the role of the virtue of complexity in asset pricing models, right? When I'm thinking about building a unified model that can accurately describe the behaviors, the risk-return trade-off for many, many assets simultaneously. And in this paper, the main theoretical result is that the asset pricing model, and we're going to formulate it through a stochastic discount factor, but we'll say it more general, the asset pricing model is generally increasing in its out-of-sample performance when we allow that asset pricing model to use more and more parameters, right? So there are different ways that you can measure the success of an asset pricing model. How attractive is the tangency portfolio in that model? What is the Sharpe ratio of the max Sharpe ratio in that entire economy? That's one way to think about model performance. So we'll be able to build portfolios with higher Sharpe ratios, all else equal, by using more parameters, right? And we'll have models that produce smaller alphas when pricing assets, smaller pricing errors. They'll be better at describing the risk-return trade-off if we give the model more parameters to work off of. All right. Now, we have seen some evidence in the literature before that suggests that this is the case. So what we're really trying to do in this paper is drill deeper into this evidence, kind of flesh it out very clearly that the benefits here are coming from enriched parameterizations, and then provide the theoretical framework to rationalize all of it, right? And then once we provide the theoretical framework, you can see very clearly what is happening in terms of behavior of models as I change the number of parameters. And once we have that, we can then connect the theory much more directly with the empirical evidence. So that's where we're going today. We don't have a lot of time to do it. So of course, I won't be able to get into a ton of details, but I'll try and give you a flavor of what it is that we're trying to get after here. All right, now I'm going to jump directly into talking about stochastic discount factors, because some of the foundational work in asset pricing by people like Lars Hansen has been about building generic representations of asset pricing models. And this is where the stochastic discount factor was born. So in some of this foundational work, we know that we can represent an asset pricing model as really just a portfolio of risky assets. Any asset pricing model that does things like rules out arbitrage opportunities has a representation as just a portfolio of the risky assets in the economy. The key question and the key thing that really defines what an asset pricing model is what is the weight that asset pricing model puts on each of the risky assets in order to find this one particular asset that delivers zero pricing errors for all the assets in the economy, right? Now, this SDF has a couple properties. One is the true SDF. These are just alphas that I have here. The true SDF produces zero alphas for all assets. And the true SDF is a portfolio, and that portfolio has a special property. It's the maximum Sharpe ratio portfolio in the economy. Now, I'm working in conditional terms here. Oftentimes, we work in unconditional terms. We're not going to get into these details very deeply here. But the point is that asset pricing models very generally are about building this weighting function. How do I build a portfolio of the risky assets that can price all assets accurately? Right. So we're very familiar with some standard approaches, right? Think Fama French. All of these standard approaches view the world from a factor pricing model perspective, right? And an SDF is no different than this. In some sense, an SDF is just one particular factor model. So when we build factor models, and they have SDF representations as well, really what they're doing is they're representing these weights on risky assets as just some function of some observables of those assets. For example, what is the market capitalization of the asset? What is the book to market ratio of the asset, and so forth? So when I build my SDF in this way, I'm actually building a factor pricing model. I'm saying that my SDF is just linear in some common factors. So in a Fama French model, of course, the 3-factor model just means that my SDF is linear in the 3 Fama French factors: size, value, and the market. Right? Now, there are lots of different ways that people have sort of proposed using factor pricing models to represent asset prices very, very broadly, right? There's, of course, the Fama French model, and then there are other versions of the Fama French model where we add additional factors. There are a number of other models out there as well, but they all share the same thing in common, that they are very small models. If you look at this representation of the asset pricing model that I've written here, notice that there are only 3 parameters in this model, right? There are 3 B coefficients. If I know those 3 coefficients, then that's the model that I can take to price all assets. Now, the question is going to be, is this the most productive way that we could build an asset pricing model? And we're going to take a very different perspective in this paper. We're going to say that such simple, small dimensional representations of the SDF are too coarse. They are understating what our asset pricing models are capable of. So we're actually going to take asset pricing modeling and push it in exactly the opposite direction. Rather than focusing on these very sparse parameterizations like Fama French, we're going to say, what happens when I allow my asset pricing model to use many, many, many parameters? Right. So here's one way you could think about this. Imagine that I wanted to build my SDF to depend not just on size, value, and momentum, right? Some original raw, let's call them XTs, right? Some original conditioning variables, but instead wanted to use an SDF that allowed me to consider all possible nonlinear transformations of those 3 variables. Well, what I could do is take these 3 variables, build one nonlinear transformation and another, and there are an arbitrary number of nonlinear transformations that I can make of those variables. If I allow myself to consider the space of nonlinear transformations of these conditioning variables that we love in asset pricing, we can have enormous factor models. So in fact, if I were to think about approximating this weight function in the SDF as a function of some nonlinear transformations of my input data, what I end up with is a factor pricing model that doesn't just have 3 factors or 5 factors, but can have thousands, maybe millions, maybe more factors. Each of those factors is going to look like the factors that we study oftentimes, in the sense that they're going to be portfolios that are essentially sorted on these nonlinear characteristics. But at this point, now we can start to make very productive comparisons. We can say which type of asset pricing model does better. A model that uses these inputs in a very simple way, like a Fama French type of formulation where I just have 3 parameters, or a model that uses these inputs in a very flexible way where I could have P parameters and P can be an extremely large number. So that's the environment that we're talking about. And the theory that we're going to work on is really going to focus on this question: what is the role of P in determining the behavior of an asset pricing model? And the critical aspect of this theory is that it has to focus on out-of-sample behaviors. Because when you start to make your models very large, when you start using machine learning approaches, your in-sample analysis is no longer valuable to you. You essentially spend all of your in-sample data learning the properties of the model, You have to evaluate that model not in sample, but on out of sample behavior. And that's what we're going to do in our theory. All right. So I guess in the interest of time, I'm going to be a little bit short in the way that I touch on some of these topics. But in order to develop an asset pricing model, I have to have a way to estimate the parameters in my SDF. Now, these parameters in SDF, they have interpretations as things like prices of risk, okay? It turns out that they are pretty generically estimable as regression coefficients. And really what I'm doing when I'm trying to estimate my regression coefficients in an SDF is that I'm trying to build an efficient portfolio of the factors. So I can interpret the SDF parameter estimate in two different but equivalent ways. One way is to view it as a portfolio that is the Sharpe ratio maximizing portfolios of the factors that I'm willing to consider. The other way to view it is as the set of parameters that actually minimizes the alphas in my economy. All right. These two representations are equivalent because high Sharpe ratio SDFs produce small pricing errors. There's a one-to-one mapping between these. All right. So in any case, this is going to be the way that we think about building our estimator. And then our question is really going to be, as I take the dimension of these factors, P, and start with very small representations and expand them all the way up to very large representations, which of these estimators tend to do better out of sample, if I let P get large or if I keep P small? Okay. All right, now, there's a ton of theory in the paper. This theory, I think, is fascinating because it requires us to do an asymptotic econometric analysis that is different than traditional econometrics, right? In traditional econometrics, we think about large T asymptotics. What happens when the number of parameters is fixed and we take the number of time series observations to infinity? Well, in machine learning, that's not what we're looking at. In machine learning, we need to think about it the other way, really. What happens when we have a fixed amount of data T and we take the number of parameters to infinity? That's the way you characterize these large, complex model behaviors. And in order to do that, you need the apparatus of random matrix theory. And so that's what's underpinning all of these results here. We're not going to talk about it in detail. Instead, I'm just going to draw you some pictures of what this theory delivers. One of the key points that's going to come out here is that the most important thing for understanding the behavior of an SDF, when you bring it out of sample and you have a lot of parameters, it's going to be the eigenvalue distribution of the factors that underlie the SDF. All right. And this is where discussion of things like the APT will be very critical. So let me get into that now. All right. So how do factor models behave under the APT? Well, the APT is a particular assumption on your factor space. What the APT says is that all assets share a relatively low dimensional covariance structure. Said in eigenvalue terms, it's like there are just a handful of eigenvalues that really dominate the behavior of the covariance of assets. That is the key assumption of the APT. Concentrated eigenvalue distribution, so you only have a couple of factors that govern everything. Well, in this type of world, our theory will tell you that as I vary the number of parameters, I actually start to optimize the performance of these models very quickly, even with a small number of parameters. So what I've done here is I've drawn the out-of-sample expected return of an SDF, its out-of-sample variance, its out-of-sample Sharpe ratio, and its out-of-sample pricing errors. These are all objects that are produced from our limit theory once you make some assumptions about what the data generating process looks like. So if I say that the data generating process is the APT, so there are just a few factors, what happens? Well, right away, the best model I could possibly build on an out-of-sample basis is going to be a model where the number of parameters or the complexity of the model is very small. I don't need a lot of parameters if there are only a few factors. I will get the best possible SDF I can build very quickly. As I increase the number of parameters, it doesn't help me at all. Now, that's an assumption. The APT is an assumption. It's not a description of the way that markets behave. It was an assumption. And then we built a bunch of asset pricing around that. So in this paper, we want to consider a different potential assumption. Our conjecture is that maybe the eigenvalues of asset returns are not very concentrated. Maybe the covariance matrix of returns has a lot of prominent factors in it. And that's what we mean by artificial intelligence pricing theory. The idea that there's not a low dimensional representation of returns that we can rely on. If this is the case, what happens when we build complex models? Well, obviously, if there are going to be a lot of factors, there's a lot of complexity in the real world, then there's going to be plausible benefits to building bigger and bigger models, to using more and more parameters. And so that's what I'm showing here. So same x-axis, I'm looking at number of parameters from very few to very many, right? And now I'm showing the same out-of-sample behaviors, and the shapes of these plots have changed pretty dramatically. Perhaps most importantly, we'll look at these bottom two. The Sharpe ratio of the SDF no longer is optimized for small models. Instead, if you want to build a powerful SDF out of sample, you need to use very large models, right? A couple of factors is not going to do it for you. And in this type of calibration, you would need tens of thousands of factors in order to get a high-performing SDF, right? And this will translate very similarly into delivering small pricing errors, small alphas, right? So I want you to keep these pictures in mind. I want you to keep a picture of an SDF Sharpe ratio as a function of the number of parameters in your mind, both under this AIPT assumption where the data requires a lot of factors versus the APT where the data does not require a lot of factors. Because now what I can do is I can go to the data and I can look across models that have a few factors all the way up to many factors. And I just want to know which of these pictures does the data look more like. All right, so let's do that now. All right, so here is the analysis that I'm going to do in the asset pricing data. So the conditioning information that I'm going to use is going to be 130 stock characteristics, right, from a paper that I have with Theis Jensen and Lasse Pedersen. All right, so these 130 characteristics are just attributes of all of the stocks that we have to work with. They're all very standard, and they're all kind of freely available on the web. We provide them if you're interested. We are going to look at building SDFs, building factor pricing models for US stocks and monthly data starting in 1963. So it's kind of like the most vanilla problem in asset pricing. Use monthly US stock data, build a good asset pricing model. And we're going to ask, does a small asset pricing model with a few factors do best? Or does a large model with a lot of factors, with a lot of parameters, do best? I'm not going to go into a lot of detail about how we build this, but one thing that I want to keep in mind here is that this neural network view of building an asset pricing model is really productive for thinking about the role of complexity in asset pricing, right? Because the way I'm going to be thinking about my models here is that I'm always holding my input information fixed. Every model that we analyze in the empirics is going to be using the exact same set of input data. The only difference is that some of the models that we build will be using these input data to produce a relatively small number of nonlinear transformations, and others will be building models out of enormous numbers of nonlinear transformations. So the question is, do I take my x's and build 5 factors out of those x's, or build 5 million factors out of those x's? That's the comparative static that we have in that theory, and that's the comparative static I want to look at in the data. And this is the main result in the paper. This is the empirical analog of the theory plots that I was showing you before. So the key point here, if we were to jump down to the Sharpe ratio plot, this is the out-of-sample Sharpe ratio of an SDF built using either a very small number of factors, right, just a handful, 5, 6, 7, versus an SDF if we use 500,000 factors. And what you can see here is that small factor pricing models, right, they really suffer rather dramatic underperformance compared to very highly parameterized asset pricing models. The key thing to remember, this is out of sample performance. Of course, in sample, big models are going to do better. But we always thought that big models would be terrible out of sample, right? Because we thought they'd be so variable, so unstable, so overfit that they'd just be disasters. That is not the case. Bigger models do better out of sample. And the intuition for it is because bigger models are better approximators. we don't know the true model, so we need big models to approximate it. Now, on top of it, we always worried that these big models would have a lot of variance, but that's where regularization and some of the other aspects of machine learning come into play that help control the behavior of these models when we go out of sample. They allow you to do rich approximations, but they don't cost you too much in terms of variance. And that's why the net gain, the net performance as an out-of-sample Sharpe ratio is dominated by these big models. And again, as I kind of alluded to before, pricing errors can be viewed as roughly the flip side of Sharpe ratio. So if I have a SDF with a high Sharpe ratio, I'm also going to be able to build models with very small alphas. They're good at describing the risk-return trade-off for lots of assets. I think I'll just spend maybe 2 or 3 more slides to highlight a couple other aspects of what we do here. So one thing that we do is we say, all right, we've looked across asset pricing models from very simple models to very rich models, and we see the rich models do better. But we have a lot of benchmark models out there, right? Things like the Fama-French model or the Ho-Shui-Zhang model, the Barulas-Shankin model. How does this compare to those? And so what I'm showing you here in panel A are the out-of-sample Sharpe ratios that you can get from the model specifications in each of the standard models versus what you get from the rich machine learning model, right? So it's really like a different ballpark in terms of performance. Out-of-sample behavior is massively benefited by complexity. So here I'm showing it in terms of Sharpe ratio. Down here, I'm showing it in terms of pricing error. And when you calculate pricing errors, you have some discretion over what your set of test assets are. So if you take even, for example, the very standard Fama-French 25 size and value sorted portfolio, probably like the most analyzed set of test assets in all of asset pricing. I'm showing in these colored bars here, these are the pricing errors out of sample from sort of the leading small factor models. And you see that the complex model cuts these pricing errors by more than half, right? So these are not marginal differences from adding complexity. The orders of magnitude are dramatic. And you see it not just with the Fama-French data, but also with the JKP factors that we study. And also if you use very complicated machine learning generated factors, you see this effect as well. All right. Last point I want to make on the empirics is that in what I showed you so far, I was building complex models using 130 characteristics as inputs. A very natural question to ask is, what would happen if you just built complex versions of, say, the Fama-French model? So you take like the Fama-French 5 factors, they each have a characteristic underlying them. So let's just build many thousands of factors that are based on nonlinear transformations of just those Fama-French characteristics. And this is the result that you see. This is the original Fama-French model's Sharpe ratio, this gray line on the left. And the blue lines next to it are the Sharpe ratios that you would get if you use the exact same data that Fama-French used to build their factors, but use it in complex, highly parameterized, non-parametric models. All right, now there are a lot of other analyses in the paper. I think I'm running out of time if I'm not mistaken, Sasha, so I should jump to my conclusion. All right, lots of slides here. All right. Okay, so here's the first sort of set of conclusions that I want to emphasize. All right, so this paper can be viewed as having 2 key components to it. The first is a theoretical argument for why large factor models, large asset pricing models, are better out of sample than small asset pricing models, right? So this can be thought of as the virtue of complexity for asset price modeling or factor pricing models, right? Contrary to our conventional wisdom, you actually do better out of sample, not worse, by making the models rich and complex. And the reason for that is because the benefits that these models give you in terms of better representing the underlying data generating process, that benefit outweighs any statistical costs of things like sampling variation that you have to deal with by estimating all those additional factors, right? Sampling variation is real and that can cost you something out of sample, but the costs are much smaller than the benefits of using a richer and more expressive model. And then I guess I would also point out that these empirical gains that we're documenting that align very closely with what the theory has to say, that we need to be careful about how we interpret that. I'm not thinking about this. We cannot think about this as what happens to asset pricing models as we add more and more predictor variables. That is not what I'm talking about. I am talking about holding the predictive information fixed. Just change the flexibility in the nonlinear specification with which I use that information. That's where the virtue of complexity shows up. So if you want to think of it another way, I'm going to just jump back to a neural network plot real quick, right? Everything that we have to say in this paper assumes that these inputs are fixed. It's asking, how much better can I do by making these nonlinear transformations more expansive, right? All right. So the statement is, for a fixed information set, I do better with richer representations of it. Now, of course, we have to think about, all right, well, where does this information set come from? And I think the nice answer for our profession is that that's where the economics is. That's our role as researchers and economists, is determining what the good inputs to use are. But once you have a sensible set of inputs, you should use them in the richest, most flexible way that you can to optimize out of sample performance. All right, so I'll pause there.
Perfect. Brian, thank you so much. And I give the floor now to Max for his comments. And afterwards, we already got a couple of questions lined up from the audience that we can introduce afterwards. So Max, please go ahead.
Yeah, thank you, Sasha. I mean, you asked me to give a bit of introduction of what we do at Quoniam, to give some context. And then we can dive right into a couple of questions that I also have. But first, maybe I start with that I really like this line, virtue of complexity, from Bryan. Just today, we had a large client for an open house. And to start with an anecdote, so he was reporting to us or telling us that they once had a pure AI manager. And for him, it was very hard as soon as the strategy was no longer shooting the lights out to keep that manager, right? So as an institutional investor, because they were not able to explain why the underperformance happened. And of course, that's in general hard with very complex models. Maybe that is one of the costs of complexity. But I think in the past, it was also not very clear from a more theoretical side, why should machine learning work, right? So this is one of the key questions if you talk to kind of also the old school quants. So why should it even work? I mean, as Bryan says, everyone grew up with being very, very cautious of not overfitting. And so that's why I really like this line of work. It gives us something also. It's not just pure empirics. Okay, we see it kind of works, but they really put in a lot of work to derive why it should work in a specific finance context. So maybe I can just very briefly share one or two slides. Okay. So, all right. So just to give some context, as you wanted, Sasha. Yeah, so Quoniam is a quantitative asset manager. So in some degree similar to Bryan's practitioner hat, probably at AQR. We are doing related things, I would say. So we started in '99 actually, have been around for quite a while. And for many years, our investment processes in equities have also been based on a multi-factor approach, right? So if you think about pharma French and extensions becoming more and more complex over the years, but still the underlying concept is the same. And then in 2018, we started also adding machine learning to our equity selection model. So that's when the journey started for us. We also have other applications of machine learning, of course. For example, we also do systematic corporate bond strategies. And there we can use machine learning to estimate historic transaction cost, Quoniam specific transaction costs, so to speak, using our historic trading data to estimate how would we've done in a backtest. And then maybe another field is going more into the area of natural language processing. If you think about GPT and other models about deriving sentiment information from textual data, that's also something we are looking at. And but maybe closing in a little bit more on the paper here. In general, when we think about challenges for applied quantitative research, right? So this is the applied is very important. I mean, we've already discussed this objective of true out of sample performance, and we've really heard a lot about that today, right? So we all know there is, markets probably are very competitive. So that's one big reason why we expect low signal to noise ratios. We have this tradition, so to speak, in many cases of people overfitting stuff. So everyone has this great backtest going from, I don't know, 100 to 1000. And then maybe another challenge is that capital markets evolve over time. And that maybe leads to a first question we could discuss. What happens when the underlying data generating process is changing over time? So how is the theory adapting to that? Or can the theory also say something about that? So that's one area. And I think we've just have this a lot in this talk. Another thing is the real world implication. So for example, what you see in the literature is that in many cases, particularly fast factors feature prominently in machine learning models when you try to predict, I don't know, the next couple of weeks, the next months. So something like a short-term reversal. And sometimes you also have that predictability in particularly illiquid parts of the assets. Tend to do the market cap weighted analysis for that to kind of distinguish that, but that maybe leads to another question that we could discuss. So how is this complexity related to model stability, also model stability over time, which could lead to transaction cost questions. So these are maybe two big challenges, and then maybe we can dive right in into a couple of questions if you want.
Yeah, definitely. Maybe at this point, Max, there was also a question from the audience that actually fits quite nicely to the idea that you just, or the questions that you just had. And one of the question was, so one of the key challenges when increasing the number of parameters, as Bryan has described, especially in certain architectures, is the vanishing gradient problem. This can cause some important nodes or parameters to have excessively small weights, reducing the impact. And the question then, how did you address these issues in your model's architecture? Maybe you can just point us a little more into that direction.
Sure, great. So these are theoretical results. We don't have to worry about gradients in the theoretical results. Okay, so the theoretical results are derived in a setting where you're not really paying specific attention to the nature of the features and the details of the architecture. This is a practical question that you have to worry about in estimation. Right now, in estimation, the issue with vanishing gradients, again, depends on architecture, right? There are plenty of high-dimensional architectures where this doesn't show up because there are closed-form solutions for them. So, for example, the empirical work that we do in this paper uses a machine learning model known as random features, right? And in random features, it's actually a closed-form solution that's estimated via ridge regression. So it's trivially optimized. There's no vanishing gradient because all of the gradients are immediately available in closed form. Now, when you move to other architectures like deep nets, if you want to start, exploring transformers with this, now you have to start dealing with gradients as a practical aspect of your implementation. But that practical aspect is sort of no different than any other high dimensional setting that you might think about. So I think about gradient behavior, collapsing, explosion, and so forth as being something about sort of the, I don't know, how would you describe it? Sort of the art of executing this in reality. And it's less about the conceptual point, about the benefits of complexity. Conceptual point stands agnostic of what's happening with how you actually decide to implement the optimization.
Max, do you want to add to this?
No, maybe I can follow up with this. I think it's also in the Q&A. So one of my questions was also, okay, what happens when the SDF changes over time? And can you say something about, is there a point, if that happens too rapidly, that this virtue of complexity is breaking down? So if you introduce totally uncorrelated factors because the SDF is changing so much, what happens to the theory?
Yeah, so what happens in the theory, you can probably think of more simply as the following. So I'm just going to very briefly re-share my slides here. All right, so these complexity curves that we show on this slide here, right? Take the Sharpe ratio plot, for example. These complexity curves, their shape is essentially generic. What happens as we change the structure of the inputs to make them, let's say, more noisy, less relevant to the prediction problem that we're trying to solve and so forth, is that they shift, right? So all else equal, if I increase the specification issue, the noisiness and so forth of my predictor set, these curves start to flatten out, right? If I make them more informative, these curves start to steepen, right? But the basic qualitative shape doesn't change. All right, so what's going on with non-stationarity? Non-stationarity is probably the single most difficult to solve problem in all of empirical asset pricing. It's a very realistic problem because, you know, we know there are forces at play that do alter the data generating process. If you want to think about how it plays into asset pricing modeling, it really can be thought of as just doing two things simultaneously. One, increases the noisiness of your problem. Two, shortens the effective history of data that you have to train on, right? Non-stationarity in a time series sense boils down to a statement that older data is less informative than more recent data. And then you are left as the modeler to sort through that and make decisions about how you should use old data versus more recent data when training your models, right? Again, this is something of the art of how you want to build these models. This is something of the role of the researcher in deciding how to train these models. There's no well-established solution for how to deal with non-stationarity. What's really fascinating about machine learning is that because it's inherently non-parametric in nature, it does tend to have more robustness to non-stationarity than parametric models do. If you make a parametric assumption, even if it's the right parametric assumption, and then the data generating process starts to drift, all of a sudden now you have the wrong data generating process. But if you have sufficient flexibility in your non-parametric approach, you sort of built in an inherent adaptability, right? So the way I like to think about it is I want to build, especially in my practical role, I don't think of it as I want to understand and solve non-stationarity. No, that's impossible. Instead, what I want to do is build models that have some degree of robustness to non-stationarity, right? And a lot of that boils down to thinking about how big of a history should I use to be training my models.
This is, can I ask one question? Because last month we had Alberto, and he was basically discussing also the role of machine learning in asset pricing. And he said that, okay, the sort of maybe the expectation we have to these models are actually a little bit too much compared to what they actually deliver. Because if you basically train models based on historical data, but where maybe sort of like factors were not existent from which that we actually know of, that the results are actually biased, right?
Yeah,
Do you think this plays a role here too, or is this basically not an issue because if you focus on this SDF?
These are separate. I think of these as totally separate issues, right? One is about how do you do empirical analysis, right? What is it that you're trying to infer via your empirical analysis, right? If you give your empirical analysis information that the market didn't have access to historically, then of course your model is going to be biased upward relative to the information, relative to what the market actually did, right? But if you do an apples to apples comparison, you try to be extraordinarily careful about information that the market had and information that your model had, then I think you'll be able to kind of feel comfortable with these conclusions not being associated with this kind of data peaking, data look ahead type of bias that you have here. Regardless, in all of the analysis that we're doing here on the empirical side, everything's apples to apples. The simple models get the same data as the complex models. We're only changing their richness in their functional form, right? So there's no scope for the complex model to sort of have more look-ahead bias than the other models. They're using the exact same data. So that point's sort of irrelevant for the types of analysis that we're looking at here.
Perfect. Thanks
if you want to ask the question, is it like a 4 Sharpe ratio from an empirical study realizable in real time? No, but that's for a lot of reasons. Some of that data wasn't available. It's totally agnostic of trading costs, yada, yada, yada.
Yeah, I think that's an important point, right? So, I mean, in your analysis, you do apples to apples, but it's important to state here that these kind of Sharpe ratios, or maybe even half that, are very hard to achieve after transaction cost from investing. And maybe people sometimes mix that up when they read the paper and extrapolate to some interpretation that's not
absolutely.
in paper.
I think in asset pricing, we are well aware of this problem, right? So the right way to interpret things like out of sample Sharpe ratio performance is this is some measure of relative utility, right? The specific quantity should not be mapped into things like, dollars that can be generated from trading this. It's more like some kind of quantification of relative utility in a low friction environment, right? That's how you should be thinking about those Sharpe ratios.
Right. Maybe there's another question, a shorter one from the audience. How big would you estimate the model's reality gap, and what are its limitations? Are market mechanisms not also based on certain vital uncertainty and also to some portion irrational behavior?
Yeah, that's a fascinating question, by the way. So let me phrase it a little bit differently. I know that when I have a large model, a large number of parameters relative to the number of training observations, that I cannot recover the true model, right? This is the entire point of using random matrix theory for understanding the behavior of large models. Traditional econometrics is really about a law of large numbers and a central limit theorem. You don't get traditional econometric. You don't get laws of large numbers or central limit theorems. We don't have convergence here. So what we realize is that because we have so many parameters relative to the amount of data, the models that we train, they may be useful, but they're still going to be far from the true model. That is always going to be the case. Now, coming back to the question, you can phrase the question as asking, once I see a certain amount of performance in your empirical model, is there a way to invert and understand what the true infeasible model's performance actually does? Can you sort of not recover the data generating process, but recover how good the data generating process would be to trade on, for example? And we have some results along those lines in our theory. They require more assumptions than the results that I showed you here. It's a fascinating question, though. But I also think it touches on the other really important point. It comes up in another question in the Q&A. I'm not exactly sure which one here. Just the recognition of the limits of learning. That's a phrase that we use often in the paper, limits to learning. Limits to learning come from lack of data, right? It doesn't matter how good your machine learning approach is. The expected out-of-sample gains from that model are predicated on how much data you have to learn from. So if you have 500 billion data points to learn from, like when you're training GPT, the gains from using very high complexity are enormous. If you use a couple thousand or tens of thousands of observations to train on, like you do when you're using monthly stock data, well, the gains, according to this theory, are positive, but they're going to be much more muted, right? So that's how I always think about limits to learning. Another way to say this is that the theory tells you machine learning is always better, right? You're never going to do better by using a small model when you could have used a big flexible machine learning model. But how much of an additional benefit are you going to get from using machine learning? It's going to be dictated by how much data you have to train on. And of course, that should be caveated by the point that Max was saying, which is, right, it's also about if you use the machine learning model appropriately, right? Because there are, as you had in one of your intro slides, of course, risks of doing things like overfitting the out of sample. This is like a first order risk that people run when they build practical machine learning models. They try a lot of models and they end up doing either explicitly or implicitly, accidentally, some sort of model selection based on how they did out of sample. And of course, that can get you into a lot of trouble, just like selecting models based on in-sample performance can get you into a lot of trouble.
That is fascinating. I think there's a lot of scope actually for discussing even further, but I think we are out of time, unfortunately. But let me thank our speakers again for giving us these, Bryan, your presentation, and Max also for the question and the discussion afterwards. Let me just briefly hint to the next seminar that's going to take place in November, on the 12th of November, where we shift a little bit from an asset pricing focus that we had in the last two sessions to more on a corporate finance focus and how AI plays a role in different settings, such as corporate innovation, with Gordon Phillips, at our academic speaker, and Jan Kinne, the founder of Istari.ai, who gives some sort of comments based on an industry and entrepreneurial perspective. So Bryan and Max, thank you guys again for participating and giving your thoughts. And
Thank you, Sasha.
we're going to follow up also with a few things that we couldn't touch upon, such as the results of the poll, for example, and we're going to do that in follow-up emails based on this webinar. So thank everybody again, and look forward to seeing you again next time on November 12th. Thank you.
Thanks, everyone. Bye.
Thanks, guys. Bye.